Much for joining us in the exciting world of multifamily investing meetup, brought to you by Xsite Capital. We know you could be anywhere else in the world, but you're here with us, so we are very thankful for you. My partners, Tanny and Leslie and I, very excited to have you. And just in case you're not familiar with us at Xsite Capital, we help people reach financial freedom through passive investing in multifamily real estate. Our goal is to grow your wealth and in the process also grow your mind. And speaking of growing your wealth or growing our wealth and our minds, we're especially excited to have a very special guest today, who is going to educate us on a very, very important topic. And I'm gonna let my partner, Tanny, introduce him shortly. But just to wrap up, once again, we appreciate you for being here with us, and hope that you're going to gain some insight, some knowledge, and hopefully some friends today. So thank you. Tanny, take it away.
Yo, Julius, thank you very much for that great kickoff, man. Appreciate it. And again, like he said, you know, this platform is an opportunity for us to grow our wealth and grow our mind. And we're very privileged to have Yona joining us today. I can remember seeing him at the presentation in Brian's meetup. Am I having an echo?
Yeah, you're having an echo.
Just, yeah, a little bit.
Is it better now?
The ocean does that sometimes.
But let me just cut to the chase. You know, we're honored to have you, Yona. I know it's, you know, you have a bunch of things you're doing. You're very busy in the industry, and as part of what we do, we provide value to our network, and we try to do this meetup every first Monday of the month. And I think a lot of people are going to learn from your experience and what you do. If people don't know what he does, he's in the industry, he's called a cost segregation expert. You know, if you need somebody that can help you do that work, he does that for a living. And he has provided a lot of value to the space. So we're really honored to have him here today with us. Before we bring him and for him to take the floor, I would like to have Leslie just share with you guys what we've been working on as a team. We have some great, exciting news on our radar, and we're excited about the future. So Leslie, just go ahead and share with them what we're working on before we bring on Yona.
Again, thank you all for joining us this evening, and we're glad, especially honored to have Yona here with us as well. So Xsite Capital has been in inception since 2019. Since then, we've been working really hard in expanding our network and building and meeting other people. We started this meetup about a year ago now, and it's been going consistently and growing consistently over time. We're very, very grateful for everybody that has been part of this platform. We've seen a lot of growth happen for ourselves and our attendees throughout the years. And that's what this community is all about. We all love helping each other grow and seeing where we could move forward from then on. So if there's any way that we could synergize and work with any one of you, please don't hesitate to reach out to us in any way along your journey. For this year, we're very excited. We're closing in on 49 unit Class A institutional class asset in DC, in Washington, DC. We're in the final phases of wrapping up that deal, and we're very excited to be able to present opportunities like this to our investors. And our investors will be able to make some good returns on this deal, and we look forward to many other deals that we're working on in the future. And bringing someone like Yona on board is very important. It's part of the process. Saving on taxes is an important part of the cash flow. So Yona, I'm not going to take too much of your time and let you take it over. You're still muted.
I know that happens to the best of us. What's going on, guys? Thank you so much. I'm so happy to be here with you guys today to share a little bit of knowledge about this incredible strategy that, if you don't know what it is already, hopefully by the end of the call, you'll have a little bit of knowledge and to, take you to the next steps. We're going to talk today about cost segregation. So it's not like the regular segregation. We're against that. We just, want to do, it's a tax method. It's a crazy name the IRS gave to this awesome tax strategy. So I wanted to share with you, I'm going to share my screen. So you're going to get a little picture of what exactly we're talking about here. If I can figure out how to do that. There we go. All right. So we got here, do a little slideshow.
Yep.
And yeah, you guys can see that. All right, we're just going to change the swap presenter. There we go. So here, this is, my name's Yona Weiss. Again, I got a little echo there also. It must be the boat. I'm telling you this. I'm
Blame it on the boat.
There we go. Just jumping back inside. We're going to talk about something that probably a lot of you haven't heard about. If you have any questions throughout, I tend to talk a little bit fast, so I'm apologizing in advance. If you have any questions, please do not hesitate to stop me. You guys, I guess Leslie, Tenny, Julius, you guys will man the chat box over there, the Q&A. Just say, hey, hold on a minute. Let's stop there. Let's go back. I'm looking back and forth to two screens here, so don't get distracted by that. Why didn't my CPA tell me about this awesome tax deduction is the title of this presentation. And the reason why, you'll see shortly, is that what we do with Madison Specs, this specialized engineering method, is not something that accountants do. So you may not even know what they are. We're going to cover here a few different things. Number one, what is cost segregation? What's depreciation first and foremost? Because if you don't know what depreciation is, you can't really understand cost segregation, because cost seg, as a lot of people call it, is just an advanced form of depreciation. We'll get into what are the benefits, what are the other sides of the thing, what's bonus depreciation, who should be doing this, when you should be doing it, what's a real estate professional. So these are some of the key terms we're going to go over. We're going to get into what is a case study. So let's just jump right in, if you don't mind. And if you guys have questions along the way, I put this together as like a presentation, so we'll try to cover everything. But if there are any questions along the way, again, don't hesitate. That's really what we're here for, so that everyone can understand this and we can, all walk away with a lot more knowledge than we started. So just a disclaimer, okay? I'm not offering any tax advice here. You got to always check with your tax and legal professional. Make sure this is educational purposes only. That's what we got to do. So thanks for the Madison legal team for that. Okay, what's depreciation? And I think some of you are not on mute, so it's just kind of some noises going on over there. So if you are not on mute, you just, there you go. All right, awesome. So what is depreciation? Depreciation sounds like a negative thing, right? It literally means that something's going down in value as time goes on, right? But that's not what it means from a tax perspective. It just means that based on the fact that things go down on value as time goes on, you get a tax deduction called depreciation. And this may be simple for a lot of you, but just to understand why the IRS gave this tax deduction, it's based on the fact that things go down as time goes on in value. But remember, the depreciation starts over when you purchase a property. Okay, so when you place that property in service, either a new construction, and new construction makes sense that you start this 27.5-year schedule or 39-year schedule for commercial properties. It starts when you build something, but it also starts when you acquire a building. So that's what's incredible about this. If you buy a building that was built in 1922, guess what? You can start your depreciation today. And what does this mean, start your depreciation? You literally get to take a tax write-off, okay? Income tax write-off, deduction of the entire property value. Entire property value minus the land. Land doesn't depreciate, but whatever's left over, you can now take as a tax write-off. What that means is you buy $1 million property, $10 million property, you now get to take $1 million tax write-off. But it doesn't happen all right away. That's why you got this 39 years or 27.5 year for residential. So that's really what we're doing. We're taking a tax deduction every single year, and we're getting, lowering our taxable income. Okay, so you make $50,000 and you get a $30,000 deduction just for buying a property. Sounds like a good deal, right? But it gets even better because with cost segregation, which is really a fancy way of saying taking that cost that you purchased the property for and segregating it, breaking it into different categories that depreciate at different lives. Okay. So we're going to have things that actually depreciate at a 5-year rate or a 7 or 15-year rate, which will allow you to take those tax deductions up front or at an accelerated pace. Okay. Now this is really important. Why is this so important? Because in real estate, the game of real estate is to make, like, you guys play Monopoly, right? Who's played Monopoly? You guys know the game? Yeah. I was just playing with my kids yesterday, Monopoly. And the main thing is you got to try to make as much money as possible, right? You buy more properties, and you don't just buy one property and then just go around the board every time and don't buy anything more, right? You want to keep buying, keep building, so you get more income. The more you have, the more income you get. So that's what's really important about this tax strategy, is that it really compounds itself when we're looking at multiple properties. So we're going to look at it in a box, but we're also going to look at it when we're going down the road. So again, what's depreciation? Let's just take a little breakdown. Buy $1 million building, you get 15%, let's put to land, because again, land doesn't depreciate. Your basis, that's the amount that you can take as a tax write-off, is very simple, $850,000. Now, divide that by 39 years, right? Straight line depreciation. And this is what every accountant does, because they don't know any better, or maybe they do know better, but don't know how to do it, or can't do the cost segregation because it requires the engineering component. You're going to get $21,794 if it's a commercial building. And if it's residential, which includes multifamily, by the way, even though multifamily is considered commercial, it's considered residential for tax purposes. $30,000 a year. That's awesome, right? Let's say this $1 million property, you're making how much? $70,000 in income, net operating income, after all expenses, right? All the rental income, 70 grand. It's pretty good, right? Let's say it's 70 grand. You immediately deduct 30,000 from your taxable income. That's pretty awesome, right? That means you only pay taxes on the remaining 40,000. Simple math. That's awesome, but you still have that 40,000 you have to pay taxes on. Cost segregation does is it produces more deductions upfront. And in this case, we're going to take, let's say, and we'll see in the example later on, close to 20%, sometimes even more than 20% or 30% of that basis front loaded into the first 5 years. So instead of, a $30,000 deduction every year, in the first 5 years, you could easily get a $70,000 deduction or more. Okay, so simple math makes sense. Cost segregation is a tool that allows you to take more deductions up front, keep that cash flow, reinvest it. That's really the compound interest that's happening when you're doing that. So again, you have to have an engineer as part of the process. Now, the engineering component is not something that can be, gone around. You need someone who understands, according to the IRS guidelines, which we're going to see later on. You actually need someone that understands the tax code, understands building construction. We're breaking out those components. Okay. And I'm going to show you the next page. What are some of those examples of those different asset classes? We accelerate depreciation, and then you get more tax deductions. As simple as that. Clear so far? Any questions?
Good?
Makes a lot of sense.
Just mute your phone so we could really get what Yona is putting out here. Thank you. You could leave any questions you have, just drop into the chat box.
Awesome. Okay, so next page, we're doing like this. Here's an example. This is directly from the case study we're going to do later on, which is relating to a multifamily property. There's basically, when we're talking about depreciation, it splits into a few different categories. So again, you have the main structure of the building, and that's really the only thing that is on a 27.5-year depreciation schedule. So what's structure? What's integral to the building? The walls, the floor, okay, the roof, windows, doors, main electric. So it's really the main structural components, and that's always going to be the majority of the building. But you have two other big categories, which this is the bulk of what the cost segregation study is the engineer identifying all these things, which are called 5-year property, meaning stuff that depreciates on a 5-year schedule. Depreciate on a 5-year schedule means if you can identify the value of all these things, you can now take them as a tax deduction in the first 5 years. Okay, as opposed to lumping everything together and getting a 2 to 3% deduction every year. You can literally take a 20% deduction over those first 5 years. Okay, so it's really accelerating that. So what are the things that are considered 5-year property, tangible property? Anything that's in a building that's not really part of the structure. So that's anything like furniture, equipment, right? Appliances, carpeting, vinyl flooring, things, even shelving or cabinets, okay? Countertops, things like that, or millwork, there's all kinds of things that are in the property, in the building that you wouldn't even think of. They're not necessarily quote unquote movable, but they're still considered personal tangible property for these purposes. And these are just some examples. Again, in this one property we did the case study on. There are more, and there's going to be more. You'll see each property is going to be different. 15-year property is the second category. These are things that's called land improvements. Anything that's outside of the property still has value to it. So landscaping, pavement, concrete, anything that's really outside the building, fencing, if you have, storm drainage systems, those grates, those cost money. And all of that can be added up and taken as a tax deduction earlier on. And this is going to be really important, as I'm going to share shortly when we talk about bonus depreciation, because not only are we going to be accelerating the depreciation of these assets, again, putting them into faster categories. So instead of lumping the whole $1 million into 27-year category, taking a little bit every year, we're going to put, 20% into the 5-year category, maybe 10% or so into the 15-year category. And therefore you're going to have a huge amount that now we're going to be taking as a faster deductions. But as we'll see later on with the bonus depreciation, you can literally take all of that in year number 1. So we're going to get to that shortly. I don't want to get ahead of myself. Okay, so is this clear? It's basically you have a building that's split up into different categories. And that's what the word is, cost segregation. We're segregating out the cost into different categories. Again, weird name. It used to be called component depreciation. I have no idea why they changed it. They called it cost segregation, but I guess that's what it is. We call it cost seg in the industry just to be cool, because you had to shorten. You say cost segregation too many times, it gets hard. I got good at it because I say it so many times. But cost seg. What we're going to do is we're going to, again, add up all the value in these assets, take them at a faster depreciation, and create a new depreciation schedule. But it's not as simple as just doing that, because if you could do that, anyone can do that. You could literally, just write up a new Excel sheet. There's a ridiculous amount of rules in the tax code that apply to doing a quality cost segregation study, which is literally jumping through a lot of hoops according to the tax code, which we're going to see later on. I have a page over here taken directly from the Cost Segregation Audit Techniques Guide, which you can find on the IRS website, and it'll show you what exactly goes into it. Without boring you too much, let's just recap. What is cost segregation? What's the benefits here? Again, we're producing cash deductions, which we're doing. We're producing more tax deductions. Now remember, if you make $100,000 and you have $100,000 of deductions, you pay no taxes on that money. Now, this is something I really want to drive home over here, especially for those of you who have worked in a corporate job. Anyone here worked in a corporate job before, W-2 income, where you're making a salary, and immediately before you get your paycheck, right, you have the taxes deducted from your paycheck, okay? That's not what happens with real estate, which is great. We have this kind of ingrained into us that we have to pay tax. We don't even get to see our money. But as part of real estate, how it works is a little bit differently. You make money, okay? You have expenses, you have income, you have expenses. At the end of the year, you add it all up and you then pay tax on whatever is left over, okay? If you have any taxable income, you now have to pay tax on that. But if you have more deductions than you even have income, or you have an equal amount, guess what? You're not going to pay any tax on that. So what we're doing is by producing these bigger cash deductions, especially in the earlier years of ownership, we're increasing cash flow, and that cash flow creates what's called the time value of money. Time value of money means $1 today is worth more than $1 5 years from now. Okay, not just because of inflation. Inflation could be 2 to 3% a year, which means $1 today is for sure worth a lot more than it is 5 years from now. But it means using that money, and it's really like borrowing from your future self. Okay, because we're not creating deductions out of thin air, but what we are doing is we're front loading those deductions to when I can use them now. So it's like you're borrowing from your future self. You may have to pay taxes later on, right? You may not, because there are strategies to get around even paying the taxes later on. But even right now, I don't have to pay taxes. I'm going to use that money that, why should I give this money to Uncle Sam when I can keep it, use it to reinvest? Okay, that's essentially what cost segregation does. So who should be doing this? And this is really a question, you know, everyone should be asking. Is this for me? Really, anyone can be doing it. If you have taxable income, it can apply to you. If you're a nonprofit, okay, you're an education or government institution, you don't pay taxes, you know, you don't have the taxable income, you don't do this, but anyone else basically can. And so if you're in a corporation or you're part of, they have different rules in terms of, you know, how much of the depreciation is carried forward, how much is it, you know, passed down to each member. But if you have an LLC, for example, it's usually split up equally according to the shares of ownership. If you're in an investment and you have a syndication, it may be a little bit differently depending on how much, you know, the limited partners, the general partners. But instead of kind of going, you know, too deep into that, that's more of a tax strategy, how you should be doing that. But basically anyone can benefit. But to keep it simple, let's say you have an LLC and each person in that LLC has a equal ownership. Let's say there's 10 people. So you have $100,000 of depreciation, each person gets $10,000. So too, if you are a passive investor, you get income, okay? And you get depreciation according to your percentage of ownership. So that's really cool because what happens is real estate is one of those investments that really you don't have any other investment like this in the world where you can make money and that money can be tax-free. Okay, at least right now. So you're getting your returns and you're going to get a tax form called the K-1, which is essentially going to show you how much money you made and how many deductions you got as well. So oftentimes, especially when the cost segregation is done, you're going to get more deductions than you even have income. So maybe you'll make, you know, $10,000 and you'll have $12,000 of income of depreciation. What happens there is that gets carried forward. You don't use it, but you also don't lose it. So you get to use it in the future. Okay. Everyone's got that really, okay, I see there's a question over here in the chat. Should we check that out? Tenny?
So
Yeah, no.
the question was, if there was a recent cost segregation on the deal before purchase, does that affect the timeline before the new buyer can do his own cost segregation?
Yeah, that's a great question. So again, the great thing about depreciation is it starts over when you buy a property. So it has nothing to do with what the previous owner did, which is really cool. So that's why I said it's kind of hypothetical because depreciation, it's not intrinsic to the property. If it was, then if you bought a property that's 30 years old, there's no more depreciation deductions. But because your depreciation schedule starts over the day you buy the property, then you get to start a whole new 27 years and you get to do a whole new cost segregation study. So it has nothing to do with what the previous owner did. So that's a really cool part of it. Yeah, great question. So here's a really, really important aspect to this. Now I said anyone can do a cost segregation study, but the better question is who should do a cost segregation study? Because it's not really for everyone and because not everyone's going to benefit equally. And I like to, you know, compare this to, I don't know if anyone remembers from high school, is a book called Animal Farm, right? George Orwell. Yeah. I didn't like the book that much, but one thing I do remember about it is that there was, you know, it's this whole book about these animals. And it's like communism showing how like some are better than the others. And it was one of the quotes in that book that I never forget was that, you know, all animals are created equal, right? But some are more equal than others, right? And it's unfortunate that, you know, some people live by that, but in the tax world, it's actually true, right? All taxpayers are created equal, but some are just more equal than others, meaning the real estate professional has more these crazy deductions that nobody else in the whole tax code has. And, you know, why is that? I don't know. Maybe it's because the Congress or real estate investors, I don't know. But whatever the case is, you got to understand what the rules are, play by the rules, use the rules. So you want to become, if you can, a real estate professional. So there's two rules, and I'm going to show you in a minute why this is so important. Because again, anyone can do cost segregation, but not everyone can benefit from it in the same way. If you're a real estate professional, and this is a tax definition, okay? This page over here is taken directly from the IRS, just formatted differently here. But what it is, it's a status. And when you have this status, you can now use passive losses or passive deductions, non-passive, to offset non-passive income. That means, and I'll break it down for what that means in a second. But let me first define what a real estate professional is. Real estate professional is someone who either you or your spouse, so only one of you needs to have this status. And this is why it's so cool. If one of you spends the majority of your time full-time job in the real estate trade or business, okay? And you're materially participating in that real estate trade or business, like in the second column, developing, redeveloping, constructing, reconstructing, acquiring, okay? So if you're buying properties, that's acquiring, converting, renting, leasing, operating, managing, or brokering. If you're a real estate broker and you own property as well, and you're involved in that, you can very well have this status. Once you have this status, and the second qualification is you need to spend more than 750 hours a year. So it's not a lot of time, 750 hours, but you need the first qualification as well, as that it's the majority of your business. So if you have a W-2 job, you can't basically also be a real estate professional, but your spouse can. Okay, so that's why it's so cool. And so once you have this status, why is it so important? Now, if you remember what I said about cost segregation and depreciation in general, is that it creates these deductions, okay, tax deductions. Now, you made income, you made money, and you're only going to pay taxes if you have any taxable income. So we have depreciation deductions. Those deductions offset your income, lower your income. Your taxable income, that is, doesn't lower your income because you keep that money in your pocket. But what happens is depreciation usually only offsets income from your properties. Okay, so property income is called passive income. Depreciation is called a passive deduction. So a passive income can only be used, right? The passive deductions can only be used to offset passive income. So again, depreciation can normally only be used to offset the property's income. So you made $100,000 in your real estate properties and you have $100,000 of depreciation. Great. You have no taxable income. You keep the whole $100,000 in your pocket. But what happens if you have $100,000 of income from your properties and you have $200,000 of income from, $200,000 of depreciation deductions? So what do you do with the extra $100,000? Now, normally, and I say normally, if you're not a real estate professional, that's called a passive loss. What happens is the $100,000 lowers your taxable income to zero. You pay no taxes. The other $100,000, sorry, you don't get a refund, but you don't lose it. It goes into like this imaginary bank account where you can then take it and carry it forward, and you can use it next year. Unless you have what's called you're a non-passive real estate professional and you make under $150,000 a year. If you make under $150,000 a year, that extra deductions you can then use against your active income, or non-passive income as the proper way to say it. Active income makes more sense to me than non-passive, but that's just me. So what does that mean, active income? Let's say you made some money from the stock market, or you made some money in a real estate deal, or you made some money from your W-2 job, or your spouse did. You can use the extra losses, right, if you have under $150,000 to offset some of that income as well. However, once you pass that threshold of $150,000, you can no longer use those passive losses unless you're a real estate professional. Real estate professional can now use any losses, no limitation, okay? No limitation. You can use as many losses as you want to offset any of your income or your spouse's income. So let's say you are a high net worth, okay, you're making a high job, maybe you're an IT professional or you're a doctor or lawyer, and your spouse is a real estate professional, and you have more deductions. You can literally use that to offset income from other ways. So a great example I like to use is a real estate broker. Okay, if you're a real estate broker and you own properties, or vice versa, you own properties and get your real estate broker's license. Let's say you're making money on deals. Let's say wholesaling or brokering or fixing and flipping, anything that's considered active income. If you also have rental properties and you're using cost segregation, especially when we're going to get to in the next page, the bonus depreciation, you can have huge tax deductions and literally offset that. So let me give you an example. I have a client who's a real estate broker, one of the top brokers in his county. Actually, I think he's the number one broker in his county in California, which is a huge market. Residential broker. He made, making over $1 million a year in transactions. He also is a rental property investor. So he bought some multifamily properties in order to get these depreciation deductions. He told me last year, and this was 2018, so right, 2019, this happened. 2018, he paid $350,000 in federal income tax. Okay, that's a lot of money when you have to write a check to the IRS for $350,000. Now, some people like to say, if you're making money, you pay taxes, right? Pay a bunch of taxes is good news, right? Because you made a lot of money, right? You've heard that before. So I think it's bogus, right? If you make a lot of money, you got to figure out ways to also offset that income so that you can keep the money you're making. And what did he do? did cost segregation on a $4.5 million purchase, okay, building. He was able to find, and we were made to do cost segregation and get $1 million of bonus depreciation. That means in the first year, he took a $1 million deduction. What did he do? He used that to offset the income, not just from his properties, because he was a real estate professional, the income from his brokerage, and he paid zero income tax. So from going, he didn't make less money, he made more money, but he paid zero taxes. So again, if he wasn't a real estate professional, he would still be limited to use the depreciation to offset only the income from your properties. But because he was a real estate professional, he used an extra, close to $1 million, probably close to $800,000 of that to offset his regular income and paid zero income tax. So that's just a cool little story I like to say. And now we'll understand what that bonus depreciation is. So there was something called Tax Cuts and Jobs Act 2017, the Trump tax laws. Again, I know I'm talking really fast. If you guys have any questions, stop me at any time. You guys are just having fun on the boat party. So
we're feeling you, man. Just keep going. This is so good.
So what happened in this Tax Cuts and Jobs Act? They created a new law called 100% bonus depreciation. Now, it used to be something that was only for new construction properties, and you're only allowed to take 50%. What this did was it said that any property that you purchase, doesn't matter if it was new construction or not, you can now take the accelerated depreciation. Okay. And again, remember all the 5-year property, 15-year property. We'll scoot back over here for those of you guys who don't remember. Yeah, all this stuff over here, 5-year property, personal tangible property, carpeting, right? Furniture, appliances, fixtures, all that good stuff. 15-year property, land improvements, right? Landscaping, pavement, right? All that good stuff outside the property. Anything that depreciates on less than 20 years, that's all the stuff that we find in a cost segregation study. You can now have the choice, the option to take all of it in year number 1. Okay. So going back to our thing over here, all of it in year number 1. So anything that's under 20-year depreciation, take it all in the first year. Instead of, accelerating it to the first 5 years or first 15 years, we're really going to take it all in year number 1. Now, this doesn't apply to 1031 exchange. There are certain cases where it can. This is something a little more complicated for your tax advisor, but you also cannot do bonus depreciation on a property that you bought and sold in the same year. Okay. So if it's a flip, you can't do bonus depreciation. And very important to note, this is going to start to phase out in 2023. So you want to take advantage now. Now's the time to take advantage of that. And what happens if you do bonus depreciation and you get 100% of these accelerated tax deductions? Now, again, I said 20, 30%, can be even more sometimes, different type of property. That's huge, okay? So, $1 million property, instead of taking, $40,000 a year, you're now taking $200,000 of tax deduction in the first year. Okay, that's huge. And just multiply that. If it's a $10 million property, that's $2 million in the first year. That's a big deduction. Now, what happens if you have more income and even if you're not a real estate professional, you get to that passive loss gets carried forward. Okay. That means you can use it in future years. Okay. So that's a little bit about bonus depreciation. Now,
so we have a question real quick. Says, do you have to also have a real estate license to qualify as a real estate professional, or just those 2 criteria?
Just those 2 criteria. You don't need a license. It has nothing to do with having a license. You just need to materially participate in the real estate trader business. So you actually have to own property, right? Because again, you're not going to be participating in your own property if you don't own it. Okay. So it's not just enough to have a broker. You actually have to own property and be involved in buying, selling, right? Acquiring, remodeling, whatever it is, managing, operating, any of that stuff. So once you do that, even if you have less than if you have 750 hours a year in those things, involved in those aspects, it doesn't matter if you're, doing other things as well, as long as your main profession is in real estate. So as long as you're a broker or you're a contractor or you're doing other stuff involved in real estate and you have the 750 hours involved in your properties, then you're good to go.
How do you try to track the 750 hours?
Yeah, so it's a good question. It should be tracked. I mean, a lot of people do it with like an Excel sheet, or there are some different types of trackers, but it's important if you want to, and I've spoken to a lot of CPAs about this. They say, if you want to claim this status, you want to track it, because if you ever get challenged by the IRS, you have to prove it. Okay. So if you're ever challenged or audited, you have to prove it, or else you lose it and you get penalized. And basically anyone that's ever, I've heard this from several CPAs, that anyone who has ever had a W-2 job and also trying to claim the real estate professional status, they basically get busted, and you can't do it. So you want to make sure you're tracking those hours. Again, there are apps that can track, things like that. If you just have an Excel sheet, you show, I'm doing X amount of time, but it has to be real. Okay. If you have one property, for example, like one single family property, you're not spending 16 hours a week, just working on that one single family, unless like you're totally remodeling it or something like that. Right. So it has to be real. Okay, great question.
And you also, quick question, you also mentioned that the bonus depreciation, which phases out in 2023, you kind of spread that out over the years. So let's say if you get into a property this year and you do the cost sec and bonus depreciation studies and all that, and you have the amount and that phases out in 2023, you could keep counting those losses past 2023, or it phases out completely as well?
No, you can keep counting the losses. What phases out is the ability to claim the 100% in 2023. Okay. So as long as you do it beforehand, and you can carry those losses forward, until you use them up.
And this applies to every kind of property, not just multifamily, correct?
Every type of property, except for your personal residence. Okay. So any type of business or investment property, you can do cost segregation.
Thanks.
Yeah, absolutely. So when is the best time to do cost segregation study? You can do it at any time, really. And it's kind of going to depend on when you want to do it, when you're going to benefit from it the most. But what I find is, the most people get the most benefit from it a lot of times is in the first year of ownership. Okay. So you're going to get a lot of benefit in that first year of ownership. Because again, you can do that bonus depreciation in the first year. You can carry those losses forward. So a lot of people do it right away. So what we do is we provide a free estimate and show you what those numbers are, even before you go ahead and do a cost segregation study. So it's important to get that, to kind of understand, what are my tax benefits going to look like, and what's kind of going to be my long-term plan. If I hold this for 5 years or 10 years or 2 years for that matter, is this going to make sense during that time period? So a lot of people, even when they're under contract on a property, they'll reach out to us. They want to see that free estimate and kind of see what that analysis will look like. That's the first thing. People get it right after the acquisition, but you can do this retroactively. Okay. You don't have to do it in the first year. You can actually do this on a property that you've owned for several years, and you don't even have to amend any tax returns in order to do that. It's called a catch up or look back study. So that's really cool. So when you're doing it that way, you're kind of doing like bonus depreciation as well, because what happens, let's say you owned a property for 5 years. You missed out on taking the 5-year assets, that accelerated depreciation on the 5-year property, right? You were taking straight line every year. If you do the bonus depreciation, the look back study, you doing retroactively, you're going to claim now this year all of the extra depreciation I missed over the past 5 years in this year. So you're really going to get like a big boost all in 1 year. And again, that does not require any amending of tax returns. You just file a form, which we'll get to on the next slide, what that's about. The other 2 times when it's beneficial to do a cost segregation study is when you do either a new construction or a major renovation. Yeah, someone had a question? No? Okay. Someone just didn't have mute on. So why is this important if you're doing a major renovation? Because as I mentioned at the beginning, and for those of you who missed that, I see a bunch of people have come since then, cost or depreciation, and again, cost segregation is just an advanced form of the depreciation. Your depreciation starts when you buy a property. And it depends on how much money was spent. So not how much money you spent, because you could just put down 20% of the building and the bank pays for the rest, or you could put down 0%, right? You could get an owner finance deal or something like that. It doesn't matter. The money for cost segregation or depreciation basis is based on the amount spent. So if you buy $1 million property, the basis is $1 million, or you're going to minus land. But the only time where you add money to the basis is when you actually add money into that property. So when you do a refinance, you do a new appraisal, doesn't help for depreciation. You don't start over. You don't get a new basis because of refinance or because of an appraisal. But what does happen is when you do a renovation, let's say you bought a building for $1 million, then 2 years later, you put in another $500,000 into renovating the property. That $500,000 you spent gets added to the basis. So that now you're depreciating that amount of money as well. And you can take a cost segregation study on those renovations. So again, the money that was spent on furniture, on the fixtures, on the things that depreciate at a faster schedule, you can now take that as a first year bonus depreciation. Again, you can do that on renovations as well. So again, you can do new construction, you can do it on renovations, you can do it acquisition, and you can do it on a look back study. Again, this means you can do it retroactively on a property that was purchased in a previous tax year. And that this catch-up look-back study does not need to amend any tax returns. You file a form 3115, 3115. It's a change of accounting method. That's it. It's pretty cool. It's done. And we do that for our clients at no extra cost because it's just something we do. Okay, so someone asked before what type of properties are the best. Is this just for apartments, just for multifamily? Is this for other types of properties as well? So for each type of property has a different reallocation. So you'll have, this is kind of a chart that I've found to be helpful to understand which types of properties are the best to do cost segregation on. And apartments, rank up there, pretty high because you're getting, between 25, 30%, sometimes even up to 35, 40% on apartment buildings. Oh, that means the amount in the basis that's reallocated to a faster depreciation schedule. Okay. So again, you buy $1 million property, subtract a certain amount for land, whatever's left over, 25 to 30%, 35% of that, what's left over can now be accelerated depreciation. So simple math, $1 million property, about $200,000 or so, you can expect in a multifamily building to be accelerated depreciation. And if you're doing that bonus depreciation, that means first year tax deduction, about, 200,000. Grocery stores, right? Hotels, they're great. Also manufacturing facilities, they have a lot of equipment, a lot of things like that, a lot of furnishings. There's going to be more in there. Mobile home parks are huge. MHPs, that's at the bottom there. They're off the charts. Over 50 to 80% I've seen on mobile home parks. Because why? Not because there's personal property there, but because it's land improvements. And again, land improvements, the pavement, the landscaping, that's really all you buy when you buy a mobile home park. You don't buy anything else. You're not buying the homes. If they're tenant-owned homes, you're just buying the land and the concrete slabs and the pads and the landscaping, et cetera, that the park is on. That's really cool because you can literally take 50 to, like I said, up to 80% I've seen in some cases, although it's a lot of times closer to 50, 60% on mobile home parks. So that's pretty cool. You can put down 20%, right? Let's say $200,000 you put down on $1 million building, and the first year get a $500,000 tax write-off. It's pretty cool. Anyways, moving right along. A little case study here. Okay, so this is a real property in Texas, right? $13.5 million purchase price. A nice big 156 unit building. Normal depreciation would have gotten $417,000. Okay, 417, 231. Again, that's taking 13.5 million, subtracting about 15% for land, taking the rest and dividing that by 27.5. That's regular straight line depreciation. Okay, that's great. $400,000 tax deduction. Who wouldn't take it, right? That's awesome. But when you have a $13 million property that's making, over $1 million in net operating income every year, so $400,000 is great, but you're still paying taxes on the remaining $600,000. So what does cost segregation do? Just like this. And again, this is a little bit of a conservative estimate, but it was still, kind of blew it out of the water here. So 15% again allocated to land. And I can do this whole, I don't know why I did this at the beginning, but I can take this spotlight over here. There you go. 250, right? 15% over 2 million land allocation. Again, that doesn't depreciate. The remaining amount, which is about $11 million, that's split up into these three categories, three remaining categories. Again, the main amount is in the 27.5 year property. That's the main structure. Walls, floor, roof, windows, doors, electric, plumbing. 15-year property, again, that's landscaping, right? Fences, right? The landscaping, the pavement, the concrete. And then the 5-year property, that's the close to $2 million. That's 70% over here in this case. Again, we're talking about, 23% allocated to the faster depreciation. That amounted in $2.6 million of first year bonus depreciation. So again, you can see from this example, it's pretty cool. Now, some people ask, well, okay, this is all great. This is all fun, right? So many awesome tax deductions. What happens? What's the downside, right? Why wouldn't anyone do this? Any questions over here? No one asked that? Well, I'm going to ask that. What's the bad part? What's the downside of doing cost segregation? So one of the things you have to realize is that when you sell a property, you have something called capital gains tax. If you make any money upon the sale of the property, you have to pay a tax on that, capital gains. You also have to pay something called depreciation recapture tax. Now, it doesn't mean that you now pay back that depreciation, but what it does mean is that you now have to pay a tax on the amount of depreciation that was taken. Okay, so this is really important because you want to understand you're now going to get taxed on the sale of a property. And so you want to make sure that this is part of your business plan, that not only are you taking these deductions up front, but you're going to be taxed later on. You want to make sure that you're going to cover that. However, and I make this point really clear, there are ways to get around the depreciation recapture tax as well. So the first way, which is ways a lot of owners do this, is something called a 1031 exchange. Probably heard of it. It means you can defer your capital gains tax. You can defer your depreciation recapture tax down the road. Okay, just push it down the road, buy a new property, exchange this property for another property. That's pretty cool. If you've never heard of that, check that out. 1031 exchange. You guys have probably done a class on that already, and if you haven't, you should, because that's a pretty cool example of another awesome real estate tax strategy. However, there's something else which is really cool, and without getting too deep into the deep intertwinings of tax strategy when it comes to real estate, there's something called partial asset disposition, which allows you to claim a lesser or little or no amount of depreciation to those assets that have already depreciated. So remember what we said, we're taking these 5-year assets, depreciating it in the first 5 years. So let's take, your example, your couches, your furniture, your appliances, all that stuff. After 5 years of owning that stuff, according to the IRS, it no longer has any tax value. That means you fully depreciate it. That gets subtracted from your basis, right? What happens when you sell a property? You can literally claim the basis is less. That stuff has no more value to it. Now, no more value, I don't pay depreciation recapture tax on that. Okay, so pretty simply put, there's ways to get around even that depreciation recapture tax. So that's pretty much the main reasons why someone wouldn't do this. Otherwise, again, this is probably the number one wealth building strategy that real estate investors have that exist in this country. So moving right along, and this pretty much covers everything, in a nutshell, but I'll just give you, this is from the Cost Segregation Audit Techniques Guide, again, directly from the IRS's website. You can read this. And this is basically the principles that need to go in, 13 principles that need to go into this study. Again, you get an engineering firm to come out and they look at the property and they make this whole 100-page long study. And then you get to claim, they produce a depreciation schedule. So you get to claim that extra depreciation once you do this. You can't do it without doing the study. It's kind of, a weird process, but that's about it. So you got to have this whole numbering system, this whole nomenclature, all the documentation, pictures and whatnot. That's what goes into it. How do you know what to get when you're looking for a cost segregation company? And, without like tooting my horn too much, but Madison Specs, we have this dual in-house, engineering, we're tax accountants. We're not a tax firm. So there are a lot of tax firms that are accounting firms that do cost segregation in-house. They have engineers in-house. There's large accounting firms, the Big Four, the Big 10, they do it in-house. However, most accountants do not because they need the engineers inside. We are not an accounting firm. We're a cost segregation company. That's all we do. Okay, pretty simple. So you have that in-house, give the, that free assessment, the free estimate upfront. You know what you're getting in before you go into it. And you have that audit defense, which means if you ever get audited, we stand behind your work and defend you at no extra charge. So that's something you really want to look for when selecting a company. Again, without tooting my horn too much, we're the biggest cost segregation company in the country, over 17,000 studies done, over $3 billion in tax savings for our clients. So you really have to check out what you can do if you do own a property or want to look into it. Happy to discuss it further. Any questions? And here's my contact info if you want to check me out. Connect with me on LinkedIn, guys. That's where I spend a lot of time. I'm very active on LinkedIn. Please send me a message, connect to me over there. just like Leslie did, and we can continue the conversation. Now's the time for questions.
Yeah, I have one, Yonar.
Yeah.
So for the kind of property you just showed right now, what are the timelines to complete the study?
Yeah,
An
the
average
timeline
timeline.
of the study is, well, I mean, how much time does it take to complete the study, or when do you need to get it done?
No, you're right. You said usually the first year is when you want to do it. Well, I'm talking about duration, like from start to finish.
Yeah. So really interesting. We, from start to finish, we try to get it done, in about 6 to 8 weeks, although we're working on a lot of processes right now during this whole COVID and a lot of downtime. We've, personally, we've been, trying to streamline our process to get it down to like under a week, to get it done. So, that's really our goal. Get it done under a week, even in 1 day, to get it done from beginning to end. That's hopefully going to happen, I'd say, by the end of this year. But otherwise, right, at this point, it takes about a month's time to get it completed. However, you don't need to get it done before the tax year. So let's say you bought a property in 2020. The cost segregation doesn't need to be completed before December 31st. It just needs to be completed before you file your taxes.
Okay. And then you guys, right now, you guys do a basic virtual tour of the property to do this segregation, or how do you guys go about carrying out the segregation?
Yeah, so we until this point we've been very active, and we have the biggest firm working in all 50 states. Make sure to send an engineer to the property. They'll take the pictures and measurements. Now, because of again this crazy situation that the world is in, we've kind of developed a system to do a virtual site tour, where we'll have someone on site that will help one of our engineers through a video conference and make measurements and take pictures through that way. So we're trying to do this, keep it hands off, hands free, technologically advanced system where with the travel restrictions it's difficult. Everyone's got to adapt. So this is one of the things we've kind of adapted to. Not everywhere and not every time. We still have engineers on the ground, but make sure that everything is compliant.
I do have a question. Let's say I'm someone that has a portfolio of a few single-family homes, and they're looking into getting into multifamily investing, and they have never done a cost segregation study on their portfolio. How can they benefit from this?
Yeah, that's a great question. Typically, again, like we mentioned before, the benefits of cost segregation is going to be proportional, right? It's a percentage of your purchase price. So the purchase price, is going to be allocated. 20%, let's say, for multifamily property. It's usually going to be less than that for a single family property. So depending on the purchase price, that's really going to be where it's beneficial. I typically don't push it or don't recommend it on purchase prices that are under $500,000, although it can still be beneficial. It's just going to be a lot less beneficial, right? Because there is a fee involved in the process. You're going to want to look at that estimate and say, I'm going to pay X, pay a few $1,000s, which is really, the minimum what it costs. And my tax benefit is going to be, Y. It's going to be $10,000, $20,000, $50,000, $100,000, $200,000. At what point to you does it make sense? And that's really where that question is going to answer.
That's a perfect way to segue into the next questions, which was asking about the average cost to perform a cost segregation for a 50 to 100 unit apartment.
Yeah, we charge based on a scope of work method, so not at all contingent to your tax savings. So even if you have $1 million property or you have a $10 million property, right? If it's a 10 unit or it's a 200 unit, the price is going to be pretty much in the same window. Okay, we usually charge somewhere between $4,000 to $6,000. That's kind of our fees. Again, this is based. I'm just speaking for our firm, based on 2020 pricing. Again, not contingent to your tax savings. So you may have the same, $1 million property or a $10 million property, and the fee, the benefits are going to be 10x, right? You're going to have $100,000 of tax benefit versus, $1 million of tax benefit, and the fee is going to be pretty much, somewhere around the same.
Okay. All right. From your experience and knowledge doing these talks and talking to other investors, how can a passive investor that is not a real estate professional really benefit from this cost segregation study?
Yeah, that's a great question as well. If they're not a real estate professional, then their benefit is going to be a lot less. Okay, it's going to be limited to the amount of income they're getting from their property. So that's really where the passive investor gets the benefit, and really not much beyond that. So if they're getting the returns from the property, their investment, they're getting returns on that. That's great. And guess what? Those returns are going to be, not taxable. Right, at least in the early years. So that's probably the greatest benefit that there is, because again, like I said before, there's basically no other no other investment vehicle that I know of that you get returns on your investment and you don't pay tax on it. So otherwise, if you're not, or your spouse is not a real estate professional, you're really limited to the income from your properties. You can use it, again, you can use depreciation to offset income from other properties. So if you have more than one property, then it can be used. But beyond that, no. Looks like Daniel has a question. Daniel.
Yeah, I just want, from a syndicator standpoint, I'm trying to grasp a lot of this too myself. Is there ever a time that I should not do a cost segregation or a bonus depreciation type scenario? I mean, like if I'm going to sell the property in a year or something to that effect, is there a scenario like that we should be aware of?
There definitely can be scenarios like that. So it's going to depend. Again, it's probably not the answer you wanted to hear, right? It's going to depend, but it's really going to depend on a lot of different factors. So for example, if you're going to sell in a year, you're really taking those benefits now and they're going to be faced with the recapture tax in a year from now. So is that going to fit with your business plan? Are you going to benefit from that? What about your investors? Are they going to benefit from it? Probably not that much. So I'd probably not recommend it in that scenario. There are certain other factors, depending on how big you get in the syndication, right? If you have over $25 million of income, of revenue a year, if your firm is that big, you get in that route, then you may have to, there's something new called the mortgage allowance, which basically allows you kind of have to opt in to electing out of taking mortgage deductions. You can only benefit up to less than 30% of your mortgage deductions, and then you're taxed on the remaining amount. So once you get into that level, there are syndications. There are definitely more factors involved.
Okay, thank you.
No problem.
So does anyone have any other questions? You could ask Jonah directly, or you could drop it in your chart. You could just unmute yourself and ask a question if you have any.
This is the time. Just ask your question. This is a very important and interesting, fascinating subject. So, so please go ahead and ask your questions.
So I'll ask another question. Oh,
yeah.
Go ahead, Daniel.
All right, so just a question about recapture, the depreciation recapture. So when you sell a building, let's say you make $500,000 in capital gain, but you have also some depreciation that you have to recapture. I'm still not clear how that all works together. And I'm going to be paying a tax on the recapture, and I'm going to be paying a tax on the capital gains. Is that correct? And if so, how do I mitigate either one of those scenarios other than a 1031 exchange? Is there a way to mitigate it, like investing in another syndication, getting more depreciation, or how could I do that? I'm sorry.
Yeah, no, absolutely. And that's a great question. So one of the scenarios, one of the strategies that I mentioned earlier is something called the partial asset disposition, which allows you to basically allocate lesser amount to any of the faster depreciation that you already claimed. But as you mentioned, another great strategy is, and that's kind of what I mentioned at the very beginning of this call, that a lot of what we talked about today is cost segregation kind of in a vacuum, right? Once you're playing the game and you're talking about having more than one property, I know you understand this, that if you have depreciation from one property, it can be used to offset depreciation from another property. And if you have depreciation recapture tax from the sale of one property, but you have losses from the cost segregation on a second property, you can use those losses to offset the taxes on the sale or the gains, the sale of the previous property. So there are definitely strategies when you're talking about having you know, a whole business and many properties involved in the process, that's really when you're playing the game and you're using this to your advantage.
Mm-hmm. Okay, thank you.
So you pretty much have a pool of depreciation if you have multiple assets, is what you're saying.
Potentially, yeah. Yeah, you have, if you have more than what can be used on that one property by itself, then you have like a pool.
So in that scenario of the passive investor who is obviously not able to apply the depreciation to their W-2 income,
Mm-hmm.
are they able to apply it to their single family real estate income that they run on the side?
Yeah, any real estate income, if it's from properties, from rental properties, doesn't matter if it's single family, multifamily, commercial, rental property income is considered passive income. The depreciation losses can be used to offset any of that, even if you're not a real estate professional. Once you are a real estate professional, you can use any of those extra losses beyond the income from your property to offset any other income as well.
Got it.
And this tax savings is something that has been around for a long time, right? This is not something that's new. It's just a bonus depreciation that's new, and it's something that's probably going to stay along in real estate even after the other one phases out.
Yeah, I mean, nobody knows really what's going to happen. You know, if someone new comes into office, but yeah, this has been around for about 40 years or so. Cost segregation. It's kind of taken new form over the years. Different things have been brought in. Like, for example, used to be flooring and different wall coverings and things like as new court cases come up, new things are brought out to light and say, oh, well, this should also be considered 5-year property, et cetera. So cost segregation, even though it was established about 40 years ago, it's been developing over the years.
Nice.
So just so I want to make sure I understand, can I use suspended passive losses to offset depreciation recapture?
Yes.
Okay.
You may not want to, but that's another story.
All right.
When I say you may not want to, because you may, again, it comes back to your major tax strategy. And again, this is something for your tax advisor, but the one reason why you may not want to is because the tax rate is probably going to be less.
Yeah.
So would you really want to use the depreciation, which can offset a higher tax rate, to offset something else that has a lower tax rate? So again, it can be done, and there are definitely people that do it. And again, it's all part of your overall business plan.
All right, so pretty much what Yona is saying, if you own any properties on here and you're paying taxes on that income, then it's time to invest in a property that's going to give you some cost segregation losses that you can use to offset the income that you're making on your rental properties. So this is really, really an advanced strategy that really can save you a lot of money and make you protect your income, which is one of the exciting reasons why real estate is such a strong investment to get into. And this is just an introduction of all the wisdom that comes out of this guy. I follow him judiciously on LinkedIn and listen to the stuff that he gives out. He gives a lot of knowledge, and we truly appreciate him being here this evening. So please check out his podcast. It's called The Wise Advice. That's correct, right?
That's right.
Check out his podcast. It's wonderful. He has some great people coming up over there. So that's another free resource that you could use for yourself to continue to add your knowledge. Again, Yona, if you could just drop it in the chat box so everybody could have it, and check it out and listen to Yona, man. He is full of knowledge.
To add to that real quick, if you want to learn how to appear on everybody's LinkedIn page, like the first person that shows up when they go into the LinkedIn page, you want to listen to one of the episodes on the podcast where he talked about LinkedIn strategy. Because right now, if I go on my LinkedIn right now, he's going to be the first person that pops up. He shared exactly step by step what you can do to do that. So that is one way to network on LinkedIn professionally. So like Leslie said, he pours out his heart and he brings in a bunch of great folks that have knowledge in this space to share their knowledge on that platform as well. So Thank you very much, Jonah, for coming. We really do appreciate this, and we hope everybody has benefited from this. We're going to share this recording. So if you have any questions, just let us know.
Awesome. Thank you guys again. I appreciate all that you guys are doing. Continue sharing knowledge, bringing experts in, and educating your community. I think it's amazing. So everyone, if we're not connected on LinkedIn already, like Tenny said, do it. Reach out. Happy to help. Not just when it comes to cost segregation, in general, right? If I can be of help or service in any way to anyone, don't hesitate.
He's very responsive on LinkedIn. Very, very responsive. So, so at this point, we're going to do a little bit of networking. Leslie, you want to talk about the next meetup? Or we're going to be having the next meetup?
So next meetup, we're going to have another industry expert come in and talk to us about negotiation. We're going to have Stephen Pasavento. He's done hundreds of wholesale deals and is doing multifamily. He has like a great platform as well. So he's going to be talking about negotiation. As we go into this period where there might be some great deals coming, you want to sharpen your negotiation skills. He had Chris Voss, the author of Never Split a Difference, on his platform and offered a class on negotiation. So he's going to be coming up and teaching us some of those skills. So you don't want to miss that next one. So hope to see you there as well.
Awesome.
I think you were breaking up a little bit, Leslie. People didn't hear the name of the person who's going to be coming.
All right, we're going to have Stephen Pasavento doing a presentation on the techniques taught by Chris Voss, the author of Never Split a Difference. So it's going to be an exciting another event, and we hope to meet you all there and keep networking, keep learning, and keep growing.
Okay, I think at this point right now, Jonas, you still here, right? Jonas, you still here, right?
Yeah, I'm here.
Okay, so we're going to create a breakout room, and we're going to just network. Basically, I encourage people when you get on this breakout room to, if you have a challenge, go up there and say, this is what the challenge that I'm having. So that if there's anybody that have a way to help you out, they'll be able to come and help you. Or if you have any thing that you're going through or you're struggling with right now, you want to share with people in the industry, see if they can help. So Allison, are you able to create the breakout room right now? I think we have about 19 people. So we're probably going to do a breakout of 4 people.
Yeah, hey Timmy. So what? I'm actually not the main host, so you will actually have to do it because I don't have access to that.
Yeah, Tanny can make you a co-host right now. Actually, you're a co-host right now.
I'm paused?
No.
Yeah, I'm about to do it. I'm about to do it right now.
Okay.
So I'm about to start right now. All right.